All right, let's dig into Occidental Petroleum's latest earnings report. Now, on the surface, it really looked like a miss. But the market? It reacted with this absolutely massive rally. So what in the world did investors see that the headline numbers didn't show? Let's get into it.
So this is the puzzle we're going to solve today. Oxy missed on revenue, but the stock shot up almost 10%. And no, that wasn't some kind of glitch. That was the market sending a really clear signal about what it actually cares about right now. And in this explainer, we're going to decode that signal for you. Okay, so to really get why the market reacted the way it did, we have to start with the numbers that caused all the confusion in the first place. The initial report was, well, it was a mixed bag for sure, with some big wins and one very, very noticeable miss.
Let's start with the bottom line, the earnings. Adjusted earnings per share came in at 31 cents.
And this was a huge beat. I mean, the consensus on Wall Street was looking for just 18 cents, so Oxy just blew right past that expectation. That's a clear win on profitability. But then we get to revenue. That came in at just over $5.1 billion. And here is the miss. Not only was that below what analysts were expecting, it was also down over 9% from the same time last year. So you've got this big earnings beat, but a revenue miss. And that is where the story starts to get really interesting.
This table really lays it all out. You see the EPS beat and the revenue miss, right? But check out that third line, production. They pumped almost 1.5 million barrels of oil equivalent per day, way above their own guidance. So operationally, they were absolutely firing on all cylinders.
And here's the market's verdict, a nearly 9.4% jump in a single day on massive volume. Investors clearly looked at that mixed report, they shrugged off the revenue miss, and they decided to focus on a much, much bigger story. So what was that bigger story? Well, the market wasn't rewarding what OXI did in the past. It was rewarding a whole new philosophy. Management came out and laid out a crystal clear playbook that puts financial strength and efficiency above all else. I mean, CEO Vicki Hollub said it herself. The focus is on a leaner, more efficient company with continued capital discipline. And you know what? This wasn't just talk. They immediately backed it up with some really aggressive action. And a huge part of this new strategy, getting that balance sheet in order. They sold off their chemicals division, OxyChem, and they immediately used that cash to attack their debt. We're talking about paying down nearly $6 billion in just a couple of months, hitting a major debt milestone. This is aggressive, focused debt reduction in action.
So the themes here are just crystal clear. 1, cut costs out in the field. 2, use asset sales to make the balance sheet stronger. And 3, give more cash back to shareholders, which they did with an 8% dividend hike. This really signals a broader trend in the whole energy sector where investors are saying, hey, we prefer predictable cash returns over those old boom and bust cycles. But of all the positive things management said, there was one number that stood out above everything else. It was the single biggest reason for the stock's massive rally, and honestly, it's the key to understanding this entire story. It all comes down to this pivot from the past to the future. Investors just looked right past the Q4 revenue. That's backward-looking, right? And they focused squarely on the 2026 capital expenditure guidance. Because that guidance, that signals future cash flow, and it contained a massive surprise. And here it is. Wall Street was expecting OXY to spend about $6.4 billion in 2026. Instead, management guided to a midpoint of just $5.7 billion. They're planning to spend significantly less money than anyone thought possible. And that's a direct result of all those operational efficiencies they've been working on. And think about it. Less spending with flat or even growing production, that is the perfect recipe for a free cash flow machine. And hey, don't just take my word for it. The pros on the street immediately flagged this. TD Cowen called the CapEx guidance the standout detail of the entire report. This was the data point. This is what drove the whole narrative and, of course, the stock price. So let's put it all together. What's our take on Oxy now? Well, looking ahead, we believe the company's strategic pivot has fundamentally changed its outlook for the better. We are initiating our coverage with an outperform rating. Look, management has proven its commitment to capital discipline, to strengthening the balance sheet, and the market is rewarding that shift in a big way. We believe this new, leaner operating model has really positioned the company to generate some serious value. So here's what we're looking for going forward. For Q1 production, we see them hitting their guidance no problem, especially given their operational momentum. We also expect the stock price to stay strong as long as management sticks to this new playbook. The key risk, though, as it always is in this sector, is macro volatility.
A sharp drop in oil prices could overwhelm even the best-run company. And that leaves us with the big question. OXY has set a new standard for capital discipline, and the market absolutely loves it. The real test now is whether this new, more efficient model can let the stock keep outperforming its peers, even if that tailwind of high oil prices starts to fade away.
This is not financial advice.